Okay, so let's start. We want to start a new topic called control accounts. We want to start a new topic called control accounts. That's the topic we want to start. That is the topic we want to start now. So let me introduce it now. Let me introduce it now. If you're a business, you normally prepare your accounts. Listen. Normally, you maintain them in what we call ledger. Ledgers. Ledgers are not accounts. I'll listen to this now. Ledgers are not accounts. Ledgers are books that contain similar accounts. Ledgers is a book that contains accounts of a similar nature. Listen. So if you have debtors, maybe you have 100 debtors, all those debtors accounts, they are normally recorded in one book, and that book is called the debtors ledger. Debtors ledger. Maybe in page 1 of the debtors ledger, you will find the account of Kamau as a debtor. In page 2, you will find the account of Njoroge as a debtor. Page 3, Koril as a debtor. Page 4, Wekesa as a debtor, and so on. So it is a ledger, is a book that contains accounts of a similar nature. I've said, if you put all your debtors account in one book, that book is called the debtors ledger. It is also known as, some books will call it, the sales ledger. Debtors ledger or sales ledger. So a sales ledger or a debtors ledger is a book that contains the accounts of debtors. If you buy goods on credit from different suppliers, meaning you have different creditors, again, you will have in your books, you will have a ledger for all the accounts of creditors. And that book, which contains accounts of all your creditors, we normally call it creditors ledger. It's also called, some books call it purchases ledger. Now you have known what is a ledger. It's a ledger. A ledger is a book that contains accounts of a similar nature. As a company, you have so many debtors, put them in one book by the name of debtors ledger. If you have so many creditors, put them in one book called creditors ledger. Maybe page 1 in the creditors ledger will contain the account of Wanyama as a creditor. Maybe page 2, Joseph as a creditor. Page 3, John as a creditor. Page 4, you have the account of maybe Koril as a creditor, and so on. Now, you may want to know, listen, you may want to know whether you have been doing the right thing in the recording of the accounts. Remember, in the recording of the accounts in these ledgers, you have been recording the transactions in the accounts in the ledger. So you want to know whether your ledgers are correct, or whether the entries you made in the accounts in the debtors ledger are correct. So what you do, you prepare what we call control accounts. So that you find out, could you have committed some errors in the recording of the transactions in the respective accounts? to know whether there's an error which has been committed between the debtors accounts or between the creditors account, you now are required to prepare control accounts. Now listen, the control account that you prepare for the sales or the debtors ledger, we normally call it the debtors ledger control account. We normally call it the debtors ledger control accounts. That is debtors ledger control account. The ledger, which is called creditors ledger, for you to know whether everything is done there right or wrong, you prepare for the creditors ledger, you prepare a control account we normally call the creditors ledger control account. Good. So we want to look at now, how do you prepare these control accounts? How do you prepare these control accounts? Listen now. So what you do for debtors ledger, for all your debtors, you open an account called debtors control account. Debtors ledger control account or debtors control account, whichever you call it. Now, in this account called the ledger or the control account, listen, you don't record each transaction that you sold goods to Wanyama, you record it here. You sold goods on credit to Ekesa, you record it here. No. You only bring in, listen, you only bring in the totals. In the control account, we use the totals only. You record using the totals. For example, when you sold goods to your customers on credit, it's obvious, we know, you must have debited Wekesa, you must have debited Coril, you must have debited John, and you must have credited sales. But now we are saying, when you sell goods on credit, and you are now preparing the debtors ledger control account, then we are now saying, you don't put in the individual figure for sales. It's true, listen, it's true, when you sell goods on credit to your customer, you normally debit the customer's account and you credit sales. That's a double entry. Good. But when it comes to control account, you use the totals. So you will find out from the question, how much were the total sales for the year? Whatever were the total credit sales, remember cash sales don't go to the debtors account. When you sell goods on cash, you normally debit cash, you credit sales. You don't debit debtors. Don't forget, we are trying to find out errors that could have been committed in our debtors account. Good. The only problem or the only difference I'm saying, when you are preparing the control accounts, this is debtors ledger control account. When you are preparing the debtors ledger control account, you don't use the individual amounts. No, you don't use the individual amounts. Instead, you use the totals. Get the total of all your credit sales. You know goods sold on credit, we normally debit debtors, you credit sales. So you come and credit here with whatever is the credit sales. Whatever it is. Listen, the point is this. If an item, get the point here now, if an item is normally debited in the debtors account, that item should also be debited. Listen, that item should also be debited in the control account. If an item is normally credited in the debtors account, then that item should be credited in the control account. Listen, so control accounts, we normally say they are not part of double entry. Get the point? They are not part of double entry. No. We normally say they are reference account. We call them reference account, or we call them memorandum accounts. They are not part of double entry. I have told you, when you sell goods on credit, you normally debit the data, whoever it is, and you credit sales. That's the double entry. But now when you are preparing the debtors control account, I have said, if an item is normally debited in the debtors account, then that item should also be debited in the control account. Listen, the only point is you now don't debit the control account with the individual sales for the year. You debit the control account with the total credit sales for the year. Good. What other transactions do you know which normally go to the debtors account? Apart from the credit sales, what other transactions do you know that normally go to the debtors account? Up to now, what we have done so far in other topics, you can tell me what other transactions. For example, when you receive cash from your customers or your debtors, the double entry is you debit cash, you credit debtors. Good. So any cash received from debtors, you normally debit cash and credit debtors. So again, that total cash received, not the individual cash, the total of the cash received from debtors should be credited in the control account. Another transaction that is normally credited or recorded in the debtors account is this. When you give a discount to your customer, you know with any discount allowed to customers, we normally debit. So you come and say a discount allowed. We normally debit the account called discount allowed and you credit debtors. When you allow your customers some discount, remember you are reducing what they owe you. So when you sell goods and you allow your customers, you debited data, meaning you are charging him. Now that he's returning, now that you are giving him a discount, he will pay you less. Let's assume you sold goods in total for 2,000. You debited Kamau's account by 2,000. But you agreed with Kamau that if he pays you within 10 days, you will give him a discount of 5%. We have discussed this before. So when you give a discount to your customer, that means you are going to receive less. So you debited bank with what you received and you credited debtors. But Kamau was allowed a discount. So with that discount, you credit the debtors account and you debit discount allowed. Because discount allowed is normally credited in the debtors account, that should also be credited in the control account. Another one. You sold goods to your customer on credit and you debited the debtors account. If that debtor is declared bankrupt, I remember we discussed it. If that debtor is declared bankrupt, that debtor must be written off. To write off that debtor, remember you debited his account when you sold goods to him to charge him. Now that he can't pay you, you must credit his debtors account. Therefore, the same thing with all the bad debts written off. With all the bad debts written off, you will also come and credit the total of the bad debts in the control account. Good. What other transaction are normally recorded in the debtors account? Another one. You sold goods to your customer on credit and you debited the debtors, just like we have done here. For whatever reason, that customer returned some of the goods. Maybe they were damaged, maybe they were spoiled. For whatever reason, that customer returned some goods. When goods are returned by debtors, you have to reduce what you owe to them. When goods are returned by debtors, when you sold the goods to the customer, you debited debtors with the credit sales. For whatever reason, if the customer returns some of the goods, you will have to reduce what the customer owes you. To reduce what the customer owes you, you have to credit. So with any return inwards, you remember we also said return inwards is called what? What's another name for return inwards? We discussed this when we were looking at the topic of double entry. We said another name for return inwards is an amount or a name called sales returns. When you have sales returns or return inwards, remember you sold goods to your customer and the customer is returning them back into the business. When you sold to the customer, you debited the customer. Now that the customer is returning, reduce what the customer owes you. So you come and credit the debtors account. Good. Now, another transaction. Before we continue with the others, listen, by the beginning of this year, you could have had a balance brought down. Maybe by end of last year, some of the debtors had not paid you yet. So you carried them forward up to the beginning of this year. By the beginning of this year, you began the year with some debtors. Debtors, listen, are assets. Assets are always a debit balance. So by the beginning of the year, you will come and see a balance brought down. Whatever is the balance by the beginning of the year, debtors are an asset. They are people you are demanding from. So they are assets to you. And an asset is always a debit balance. Good. That's another thing that is normally entered in the debtors account. Now, listen. So we are trying to look for what are the transactions that are normally recorded in the debtors account. Those same transactions are recorded in the control account. So it is important to know the double entry. Now, I have started with the balance by the beginning of the year. That's where we should even have started. What is the balance by the beginning of the year? Then you go look for the transactions that took place during the year affecting debtors. I've told you one of them is the credit sales, not cash sales, credit sales. When you sell goods on credit, you normally debit debtors and you credit sales. Because you normally debit debtors, debit the same amount in the control account. That's one. The other thing we have talked about is any discount allowed. When you allow some customers a discount, it's because you wanted them to pay you early. So when they paid you, you received the cash. You debited cash and you credited debtors. So you can even say here, it is either cash or checks received. Maybe you could have received a check. The company paid you or the debtor paid you by check. So we are saying it is either cash or check received. Cash or check received, whatever it is. Cash or check received. Good. When you receive from your debtor, you debited bank if you received a check, or you debited cash if you received cash, and you credited debtors. Good. Then I've said, if you allowed that debtor some discount, you allowed your customers a discount, then they were paying you less. So with the discount allowed, you are going to debit debtors, discount allowed, and you're going to credit debtors. That's what I've told you. Then I've also talked about bad debts. You sold goods to your customer, you debited the customer. For whatever reason, he can't pay you, he is declared bankrupt, you have to write him off. That's why we are crediting. One day you sold goods to your customer, you debited your customer's account. For whatever reason, he's returning some of the goods, and therefore, you must have credited debtor's account. Good. Now, we still want to talk about some more transactions, but these are the most common ones. These are the most common ones when it comes to debtors, but there are still some more entries. Listen, you sold goods to your customer on credit. Listen to this. You sold goods to your customers on credit, you told them, if they don't pay you within 10 days, you are going to charge them interest. If they don't pay you within 10 days, you are going to charge them interest. Suppose the customers never paid you in good time, and so you have to charge them interest. Tell me this, will that interest be debited in the debtor's account, or will it be credited? You are charging your customer some interest for not paying you in good time. So it is obvious you're going to increase what the customer owes you. To increase what the customer owes you, of course, you debit his account. So with any interest charged to debtors, that is another transaction that should be debited in the debtor's account. Good. Another one. This check that we received from debtors, immediately we received it, listen, we debited bank in our books and we credited debtors. Suppose when we went to present the check to the bank, this bank told us that they can't honor that check. Why? Because maybe the creditor or the debtor did not have sufficient funds. But listen, the moment he wrote to you the check, you debited bank. You debited bank as an asset and you credited debtor. That's okay. Then you took the check to the bank for cashing. And you are told this guy has insufficient funds. So this check that you received from your customer, suppose it became dishonored. So if that check becomes dishonored, then in principle, the customer has not paid you. In principle, the customer has not paid you. And therefore, you have to cancel this credit that you made. You made a credit of whatever the amount here, showing like that customer had paid you. But now we are seeing this customer has not paid you. So you cancel that. So we are saying another transaction that can come to the debtor's account is any dishonored checks. Dishonored checks. Any dishonored checks from debtors. Any dishonored checks from debtors or customers. Any dishonored checks from customers. Remember, you credited it. Now that the customer's check was dishonored, you cancel the credit. Because ideally he has not paid you. You cancel the credit by debiting. Good. That's another amount that could go to a debtor's control account or a debtor's account. Let me talk about another one. Now, let me talk about another one now. There is normally something we call when a customer wants to pay you, he can write to you what we call a bill of exchange. A bill of exchange is a document. Listen, it's not common, but sometimes you can agree. You have sold goods to your customer, and you are telling your customer, listen, promise me that you will pay me in 30 days. So a customer can write to you what we call a bill of exchange. It's a document that shows that this customer will pay you within 30 days. It's like what you can call I owe you, an IOU. Now, so if you have that kind of a document, listen, it is like a guarantee that this customer will pay you within 30 days. Listen, we call such a bill of exchange to you as a business. You are receiving it. Listen, you are the one receiving it. So because you are the one receiving it, it becomes, to you, it becomes what we call bills receivable. Or in other words, it's called bills of exchange receivable. I have told you, let me repeat. You sold goods to your customer on credit. You wanted to be guaranteed that this customer will pay you. So you told him to promise or to commit himself that he will pay you. So he signed what we call a bill of exchange. He signed. On that face of it, it's a document. He signed a bill of exchange. So listen, I have told you that bill of exchange is as good as cash because he has promised to pay you within 30 days. So when you receive the bill of exchange today for 10,000, 50,000, that bill of exchange is as good. Listen, it is as good as if the customer has paid you. Why is it as good? Listen, because you can also take it to your bank and tell them, I have a promise here that somebody will pay me within 30 days. Please take, you tell your bank, please take this bill of 10,000, give me the money. Then when it comes to 30 days later, your customer now, listen, will not pay you, but it will pay the bank. Hope you are following. It's a document which the customer signed and promised to pay you within how long? Within 30 days. Okay? I've told you, it's like a guarantee. When you receive that document, you as a business, to you, I have said, it becomes a bill receivable. And once I receive it, it's as good as the customer having paid me. Why? Because it's like a guarantee. Why is it like a guarantee? Because we normally say in accounting that you can, listen, you can discount that bill. What do you mean by discounting the bill? You can take it to the bank and tell them, somebody has promised to pay me by 30th of November or by end of this year, according to your agreement, but I can't wait until that day. Please give me the money, then you take this bill. So what the bank will do, if the bill of exchange was for 10,000, they might give you something slightly less than 10,000. So that when they are going to demand their 10,000 from the customer, from your customer in December, then they will demand 10,000, but they gave you something like 9,500, and the bank will make their profit of 500 or 1,000, whatever it is. That's how a bill of exchange operates. I hope you are following. I've said it's a document that guarantees that one person owes another one. And I've told you it's as good as if you are being paid. Okay? It's as good as if you are being paid. So you sold goods to your customer here on credit and you debited debtors. You can see this customer signed that bill of exchange. He signed it, meaning he committed to pay you by the end of the year. When you receive that bill, it's as good as being paid. It's as good like you have money. Why is it as good? Because you may decide not to wait until December to get the money. You can go to the bank and cash the bill before it matures. It will mature in December, but you can go to the bank and tell them, I have a bill here from Mr. Wekesa who has promised to pay me in December. I can't wait for that December. Please give me the money, and you take the bill. The bank, now you receive the money from Wekesa in December. The bank will give you the money in the face of the bill, less a small charge. Less a small charge. Meaning, now listen, when you receive that bill, it's like the debtor has actually paid you. It's like cash. It's like the check that normally they pay you with. It's only that now we are calling it bills receivable. So whatever is any bills that you are receiving, any bills receivable from debtors should be credited in this account. So you debit the account called bills receivable, just like you debit bank, just like you debit cash, you debit the bills receivable and credit bank and credit the customer. Good. Now listen. It may happen, that's true, this customer promised to pay you by December or by the end of this month. And when you kept the bill, because you could have kept it, not discounted it, you kept the bill. When you went to cash that bill or to tell him to pay you the bill, you realize that that customer now is bankrupt. He can't honor the bill. The day you received it, you debited you debited the bills receivable, you credited debtor, implying like the debtor has paid you, which I told you, because it's as good as cash. In principle, he has paid you. But he has promised to pay you by the end of the month. So you kept the bill until it matures. When the date of maturity came, you went to your customer and told him, now honor the bill. Suppose he did not have the money or he has been declared bankrupt. Meaning, therefore, that he cannot honor this bill of exchange or this bills receivable. And therefore, it becomes dishonored. Just like a check would become dishonored, the same thing. If it becomes dishonored, listen, has the customer actually paid you? No. So you must cancel the credit you made. How? By debiting now. So we are saying any bills receivable dishonored, any bills dishonored, any bills receivable which are dishonored, you have to debit the account. Why? Because you credited debtors when you received it. Okay? I hope you have understood that concept. So now that it has become dishonored, it can't be honored, you cancel the credit you made by debiting. Good. So what I'm trying to say is this, which I'm hoping you are getting something now. That when you are required to prepare a control account, I have said, if something is supposed to be debited in the debtor's account, that same thing should also be debited in the control account. If an item is supposed to be credited in the debtor's account, that same item should also be credited in the control account. That's why I told you these control accounts are not part of double entry. They are just memorandum accounts. We call them memorandum accounts or reference accounts. Good. But they are just there to help you to know whether you committed an error in the respective accounts. Because I told you, here, you always bring the totals only. You always bring the totals only, not the individual entries. No. You get the totals of the bills receivable, get the totals of the total credit sales, get the total of the total interest that you're charging, get the total of the discount allowed, get the totals of the bad debts that you have written to all your customers. Get their totals there. Good. Now, listen, before I continue, I want to mention another key point. Listen. One time, you sold goods on credit to your customer called Corel. When you sold the goods on credit to your Corel, you must have debited Corel. So you came and debited it here, and you see their sales, 2,000. So here is Coril as a debtor. As a debtor. Now listen. It may happen that you as a businessman, you normally also purchase goods from Coril. You normally purchase goods from Coril. So when you purchase goods from Coril on credit, you must have debited when you purchased goods on credit from Coril or as a creditor now, as a creditor. You must have debited creditors. No, you must have debited purchases and you must have credited Coril as a creditor. And you came and said your purchases. We have already done double entry, maybe of 1.5. Listen. So here is one person who is both a debtor and at the same time a creditor. As a debtor, Coril owes us 2,000 shillings. As a creditor, we owe Coril 1,500. Listen, when one person is both a debtor and a creditor, the question is this: do I have to wait for Coril to pay me my 2,000? Then from the same money, I pay him the 1.5? The answer is no. Coril doesn't have to pay me 2,000. Then I use the same money to pay him what I owe to him, which is 1.5. Because he owes us 2,000 as a debtor. We owe him 1.5 as a creditor. So what do you have to do as a business? Listen, you don't have to wait until he pays you 2,000 so that you give him 1.5. No. So what you do, listen, what you do, you offset the two balances so that you find out who owes to who the difference of 500. So if we owe the creditor, Coril, then we pay him 500 and that will be end. If he owes us 500, then he pays us 500, that will be the end. So in other words, we are saying, whenever one person is a debtor at the same time a creditor, you offset the two balances. You offset the two balances. Listen, how do you offset? By doing what we call a contra entry between Coril as a debtor and Coril as a creditor. So what you normally do is that you have to close the account with a smaller balance. That's what we normally do. You close the account with a smaller balance to the account with a bigger balance, so that we get the net amount, which is 500, to be either Coril owes me 500 or I owe Coril 500, whichever it is. But whenever there is a one person being a debtor at the same time a creditor, we are saying offset the two balances. How? By debiting Coril as a creditor that 1,500 to transfer it from an account with a smaller balance to the account with a bigger balance. So you debit Coril as a debt, as a creditor, and you credit Coril as a debtor. That way you have done what we call a set-off, or you also call it a contra entry. So some books will call it contra, some books will call it set-offs, whichever the question term will be told. So you debit creditors as Coril as a creditor, and you credit Coril as a debtor. So that now you come and say, balance carry down, which is 500. So effectively, Coril owes me 500 only. If he can pay me 500, then I have no problem. I will have cleared his debt. Okay? But the point I'm trying to say is, when one person is a debtor, at the same time a creditor, you offset. How have we offsetted? Listen, I've gone to the debtor's account and credited. That's what I want you to see. I've gone to the debtor's account and I've credited. Because when I sold to Coril as a debtor, I debited. Now that I'm doing a contra, I have to debit creditors, I have to credit debtors. So now that I'm doing control accounts, I have to find out in total how many guys were there that we did a contra for. I have told you any setup is credited in the debtors account, and therefore in the control account also it should be credited. Good. So you come and say a contra, or what we call set off. This is when one person is a debtor at the same time a creditor. You sold goods to the customer, you must have debited. To offset him, you credit. Or to do a contra for him, you credit. Okay? Good. That's another transaction that may go to the debtor's account, which effectively it will find itself in the control account also. In the control account. Good. Now, before we finish the control account for debtors, listen. Last year, another illustration. Last year, I sold goods to Wekesa. Sales. We sold goods to Wekesa for sales, shillings 2,000. Wekesa gave us a check of shillings 3,000. Wekesa gave us a check of shillings 3,000. When we received that check of 3,000, we must have debited bank. We must have credited Wekesa. You came and said, dear bank, 3,000. Then automatically, listen, by the end of the year, you normally close your books by the end of the year. So what you did, you came and said, dear balance carry down, that is 1,000. That 1,000, what does it represent? Listen carefully. What does it represent? Here is a customer we sold goods to on credit for 2,000. He paid us 3,000. So this 1,000, which I have carried down on the credit side, which automatically means I'll bring it down on the credit side, that 1,000 shows what? Listen, it shows an amount that we as a company, we now owe to Wekesa. Wekesa does not owe me 1,000. Wekesa, we owe Wekesa 1,000. It could only be possible that we owe Wekesa 1,000 if it happens like this. Let's use another one now. Koech. We sold goods to Koech for 5,000. If Koech gave us a check of 3,000, we must have debited bank. We must have credited Koech 3,000. Come the end of the year, you carry down the balance. When you are balancing the account, 2,000. Then you must have brought down the balance by the beginning, 2,000. So here, we are still demanding 2,000 shillings from Coril. So in most cases, listen, debtors are always a debit balance. Debtors are always a debit balance, representing that you are demanding from that customer by the beginning of the year. But listen carefully now, but it may happen that you may also have some debtors account which have a credit balance, like the first one of Wekesa. Wekesa's account is not a debit balance. Wekesa's account is a credit balance. Meaning, if he overpaid you, then you as a company, you owe them that 1,000. You don't demand from them. Instead, you owe them that 1,000. When you owe them that 1,000, that becomes a liability. And a liability is always a credit balance. But I've told you, in most cases, debtors are always a debtor, an asset. It's people we are demanding money from. So they are always assets with debit. Now, listen. Meaning, therefore, when I take you back now to the control account, I began the year with a brought down. You can see it on the debit side. That brought down on the debit side is the normal debtors. The total, all the customers we are demanding money from by the beginning of the year, that's what I brought down. Okay? Now, but we can now see again that it is possible that you may owe some customers, some of your debtors, like here Wekesa. We are not demanding from Wekesa now, like we were demanding from Corel. We are now not demanding from Wekesa. Instead, we owe Wekesa 1,000. Now listen, it means therefore that by the beginning of the year, you could also have, listen, you could also have another balance brought down by the beginning of the year. What does it represent? It represents how much as a business we owe to our creditors, no, to our debtors. So, I have emphasized and said, in most cases, debtors are always a debit balance. So that's why it's always brought down by the beginning of the year to represent the customers who owe you. But there are few of your customers who could have overpaid you. So by end of last year, you are not demanding from them like most of your customers. No. By end of last year, you owe them instead. Meaning you have a liability to them. A liability is always a credit balance. So if you have a few of those customers, then you bring down their balances on the credit. So this debtors control account could have two opening balances. The most common one is the debit one, because a customer is a debtor is an asset is always a debit balance. But I've told you, there are times when a customer may have overpaid us by end of last year, meaning by the beginning of this year, we owe the customer instead. So you bring down that balance. Good. So I think I've recorded or shown you most of the things that would go to a control account of debtors. Remember, I told you, you are only bringing the total amounts, not the individual entries. Because this is why we owe. By the way, these accounts are also known as total debtors control account. Total debtors control account. Okay, good. So I've shown you what is normally debited in the debtors. Every time you are increasing what the customer owes you, you debit. Anytime you are reducing what the customer owes you, you credit. Are you there? Good. Now listen. By the end of the year, you will also calculate the balances carried down. In most questions, you are given also by the end of the year, what could be the balance by the end of the year? Listen. If you are given the balance by the end of the year, and it's a debtor, meaning we are demanding from our customers, I want you to listen carefully. Balance by the end of the year, how do you record it? If you are given that by the end of the year, our debtors have a debit balance, listen, a debit balance of 10,000, meaning we are still demanding from them 10,000 as an asset. Listen, I have told you, assets are always a debit balance. Listen carefully. But the question is, will you now come and carry down that 10,000 on the debit side? The answer is no. Listen, by the end of the year, you first come and carry down the balance. You come and see a balance carry down 10,000. Listen, so that when you close your books like this, that balance will be brought down on the debit side to represent an asset of debtors. I have told you, assets are always a debit balance. Listen, but they are a debit balance as a brought down, not as a carry down. As a brought down. You normally determine the balance of an account by where the balance brought down of that account is. But the point is this. Come the end of the year, listen, you could not have brought down the balance on the debit side without first carrying it down. So the point is, if you are told by the question that by the end of the year, the debtor's balance was 10,000 credit or debit, 10,000 debit, first I have said carry it down on the credit side so that it will be brought down on the debit side to be reflected as a debit balance. Listen, for the opening balances, if we were told our debtors by the beginning of the year were 2,000 debit, you just bring it down on the debit side as 2,000. You just bring it down on the debit side as 2,000. Why? Listen, why? Because it was carried down last year. So by the beginning of this year, I just bring it down 2,000. Then I'm saying, by the end of the year again, if you are told we have another debit of 10,000, that is the issue now. Do you carry down on the debit just because it's a debit balance? No. I have said, first carry it down on the opposite side of that account. Do what? Carry it down. So that when it's brought down, it will be brought down on the right side. And I've told you, we determine the balance of an account not by where the carry down is, but by where the brought down is. And two, I've also told you, there is no way you can have a brought down without a carry down by the end of the year. So first we carry down on the credit side so that it is brought down on the debit to appear as an asset. I've told you, what about the opening balance? The opening balance, if it's a debit balance by the beginning of the year, just bring it down as a debit balance. Bring it down as a debit balance. Why? Because it was carried down last year. So you are only bringing it down this year. The challenge is always on the closing balances. Listen, if by the beginning of the year you are told we had 2,500 credit balances of debtors, credit balances come because I told you the customer could have overpaid us. So we owe them. A liability is a credit balance. So maybe another 3,000. That's what we owe them by the beginning of the year. Good. But then, what if I'm told by the end of the year, again, we have another credit balance of 5,000. Credit balance of 5,000. If it's a credit balance, then I'm saying it should be brought down on the credit side, 5,000. Listen, but you cannot have a brought down by the end of the year again without a carry down. Without a carry down. So automatically you will come and see your balance carry down first, 5,000. So that once you close your books, it will now be brought down on the credit side. Are you there? As a liability. So when it comes to the questions on control account, one must be very careful with the closing balances. If it's a debit balance, first carry down on the credit. If it's a credit balance, I've said, first carry down on the debit so that it will be brought down on the respective side. Good. So I think I'm now through with the explanation of how to prepare a debtors ledger control account. I've told you it is also known as sales ledger control account. Good. Before we discuss the creditors ledger control account, let's now do some write-up. Let us do something as we write them down. Good. So let's write something down for this topic now. Semi-V, put down this. Put down this. As the business, the topic is control accounts. The topic is control accounts. The topic is control accounts. Then you say this. As the business expands, comma, errors may become difficult to locate. As the business expands, errors may become difficult to locate. And therefore, a solution to this is to come up. A solution to this is to come up with a type of a trial balance. The solution to this is to come up with a type of a trial balance for each ledger. For each ledger. The following, another paragraph. The following are the types of control accounts. The following are the types of control accounts for debtors ledger and creditors ledger. The following are the types of control accounts for debtors ledger and creditors ledger. Number one, debtors stroke sales control account. Debtors stroke sales ledger. Debtors stroke sales ledger control account. Debtors stroke sales ledger control account. Debtors stroke sales ledger control account. Number two, creditors stroke purchases ledger control account. Creditors stroke purchases ledger control account. Good. Another paragraph. The following is the format. The following is the format of a debtors ledger control account. The following is the format of a debtors ledger control account. The following is the format of a debtors ledger control account. Good. Now you can show those. That's an example. You can draw that now. Take a few minutes to draw it. Take a few minutes to draw that ledger. Take a few minutes to draw that ledger. Bring down the balances by the beginning. If it's a debit balance, we have agreed you bring it down on the debit side. If it's a credit balance, we have agreed you bring it down on the credit side. Good. Okay, so finish copying. We want to develop the topic slightly now. Finish. We want to develop the topic. We want to talk about the second type of ledger. So copy. So on the debit, we have balance brought down. We have that credit sales. We have talked about it. Then we have any interest charge to debtors because they were not paying in good time. You had to charge them interest. Then you have dishonored checks from debtors because you were given a check. When you received the money, the check, you debited bank, you credited debtors. But now that the check has become dishonored, you cancel it from the credit side by debiting. Bills receivable, I told you, you were given a bill of exchange. So to you as a business, it became a bill receivable. I told you the moment you received it, you debited the account called bills receivable, you credited data because it's as good as being paid. What if it became dishonored at the date of maturity? You cancel the credit by debiting it. That's what we are doing. Then on the credit side, we have things like discount allowed. Obvious, when you sold goods to your customer, you debited. If you allowed a discount to your customer, you reduce what the customer owes you by crediting. When you sold goods to your customer, you debited. When the customer pays you, you credit, obvious, with a cash received or check received. When you sold goods to your customer, you debited. If that customer is declared bankrupt and you can't receive from him, you write him off. To write off the data, you credit. You sold goods to your customer, you debited. But for whatever reason a customer returns, you reduce what the customer owes you by crediting. Then we have the bills receivable, I've talked about it. Then we have the set-off or the contra. The set-off or the contra. I told you this is when one person was a debtor at the same time a creditor. You cancel. Because he was a debtor, you must have debited his account. To cancel from there, you credit. You debited debtors when you sold. Now to cancel it or to do a contra, you credit. Good. Then I've discussed effectively the closing balances. That if it's a debit balance, by the end, first carry down on the credit. And if it is a credit balance, by the end, first carry down on the debit. Very important to remember the closing balances. Finish, we go to the second type of ledger. We want to go to the second type of ledger now. Okay. I hope you're through now. I hope you're through now. Okay. Good. So let's now go to the second type of ledger. Another book that may contain so many accounts is the account of creditors. You may have 100 creditors and you want to know, could you have committed an error in the entering of their transactions? So you prepare a sort of like a trial balance. But we are saying it's not a trial balance, it's called a control account. So you open an account we call creditors ledger control accounts. Let me talk about it first. Creditors ledger control account. One time, let me go through again the transactions. One time, you purchased goods from your suppliers. Now you have suppliers. When you purchase goods from them, you must have debited purchases. You must have credited creditors to increase what you owe to them. So you came and said, dear, credit purchases. Credit purchases. Whatever it is, that was the entry you made for purchases. Only credit. Because if you bought goods by cash, you must have debited cash. You must have credited bank. When you bought goods by cash, you must have debited purchases. You must have credited bank. So that transaction did not affect the creditor's account. No. So you don't enter it in the control account. Good. Listen. If you paid the creditors by cash or by check, then you must reduce what you owe to them. So when you pay creditors, you normally debit creditors and credit bank. This is cash or checks paid. To your creditors, that's what we are saying. Listen, you bought goods from your creditor. When you bought the goods, you credited creditors. That's what we have done. For whatever reason, these creditors or these goods are more than you needed. So what did you decide to do as a business? You returned them to your suppliers. So when you return goods to your suppliers, automatically you must reduce what you owe to them. So when you have things like what we call return outwards, you remember when we were looking at the double entry topic, we said they are also known as purchases returns. When you return goods to your suppliers, you reduce what you owe to your suppliers. How? By debiting your creditors. With the return outwards, we also call it purchases returns. Good. Another point. These creditors told you are buying from them. If you don't pay them within 30 days, they will charge you interest. They will charge you interest. Suppose you fail to pay them within 30 days, and therefore they had to charge you interest. If they had to charge you interest, then automatically that will make you increase what you owe to them. So any interest charged by creditors, you will have to credit because they are charging you now. Good. Okay. Next. You purchased goods from your suppliers on credit. And you told, let's assume Kamau here. You purchased goods from Kamau on credit and you come and said, dear, purchases 5,000. Kamau told you, if you pay him within 10 days, he will give you a discount of 1,000. So you paid Kamau within 10 days and you must have debited Kamau by 4,000. You must have credited bank by 4,000. Do you leave the account of Kamau like this? No. Why? Because this time you still don't owe him anything. He told you that if you pay him within 10 days, he will give you a discount of 1,000. So that 1,000, which you can see is the difference here, represents the discount you are receiving from your creditors. So that 1,000, you must have debited creditors. You must have debited Kamau as a creditor. You must have credited the account called discount received. So in the control account, the same, that if there is any discount we are receiving from our creditors, if there is any discount received, that discount received should be debited. Any discount received from creditors. Good. Good. Now, another one. This check, you gave Kamau a check of 4,000. The moment you gave him that check, you debited Kamau's account. That's okay. But when Kamau took the check to the bank for payment, that check was dishonored. So have you actually paid Kamau? No. And therefore, again, we are saying, when a check from a creditor or given to a creditor becomes dishonored, then you have not paid him. So go back and increase what you owe him. Because when you debited Kamau as a creditor, you showed like you have paid him and therefore you are reducing your amount that you owe to him. But have you actually paid him? No, because the check became dishonored. Therefore, we are saying when you have any dishonored checks, should be credited. Okay? Any dishonored checks. Good. Listen. You purchased goods from Kamau on credit. You told him, I'll pay you within 30 days. Listen carefully. I'll pay you within 30 days. So Kamau told you, give me a guarantee. And so you signed, listen, you signed a bill of exchange. You signed a bill of exchange, implying that you have guaranteed to pay him that money within 30 days. So when you gave Kamau that bill of exchange, it's as good as if you have paid him. Why? Because I told you, he can also go and cash the bill before it matures. So it's as good as being paid, as if you have paid your creditors. So we are coming and saying here to you, listen, when you wrote and you signed that bill, to you, it became, listen to you, it became a bill payable. It became a bill payable. You are the one paying using that bill. So it became a bill payable. So with any bills payable, you will debit creditors. The other one was bills receivable. Don't confuse. This time, it's a bill payable. Okay? It's a bill payable. Because you have guaranteed to pay Wekesa or Kamau on 30th and you signed that bill. So it's as good like you have paid him. So the way you debited creditors with the money in the bank or with the cash, do the same with the bills payable. Because he can go and cash it. Listen, what if again, after 30 days, that bill which you signed and promised to pay him becomes dishonored? Have you actually paid Kamau? No. So, do you still owe Kamau for the goods you purchased from them? Yes. So when a bill becomes dishonored, that again, you as a creditor, you as the business, you have to increase again what you owe to Kamau. So we come and credit here and they say your bills payable dishonored. If they are dishonored, you credit. That's what we are saying. Good. Another one. Let me take you back here. Where? Coril. Good. Now look at this. Coril was both a debtor and a creditor. We had initially sold goods to a Kamau or to Coril for 2,000. We purchased from Coril goods worth 1,500. We credited Coril as a creditor. We debited Coril as a debtor. Then I told you, we don't have to wait for Coril to pay me 2,000. Then I give him back 1,500. No. What do? Offset. So how did you offset? By transferring the account with a smaller balance to the account with a bigger balance. So you must have debited Coril as a creditor. You must have debited Coril as a creditor. And you must have credited Coril as a debtor. That's what you did. So in our debtors control, we credited. Now what do you do in the control for accounts for creditors? You must also debit. You must also debit. So we are coming and saying here, if there is any contra entry, any contra or set-offs, any contra or set-offs, that's what you debit. Just like we credited the control account for creditors, where just like we credited the control accounts for creditors with the set-off here down, good. Now we are saying with the set-offs for creditors, you come and debit, good. Now we can move on. Listen again. You paid Wekesa by check or by cash, and you debited. Listen, you repaid Wekesa 5,000 by cash, and you debited. Suppose Wekesa refunded back some of that amount. You paid them by check or by cash. And the double entry is you credit bank, obvious, you debit creditors. That's what you did by whatever the amount. But for whatever reason now, you are being required, or Wekesa is required to refund you that money. You have paid them, now they are refunding to you. To refund you that amount, will you debit this creditor's account or will you credit? It is obvious you will have to credit. Because when you paid them, you reduce what they are owing you. Now that they are refunding to you, any refund from creditors, that again becomes a credit. So we come and say a refund to creditors. If you refunded, you paid them. No, this should be refund by creditors, not to creditors. Refund by creditors. Sorry, this should be refund by creditors or refund from creditors. Let's put it that way. Refund from creditors. This is refund from creditors. Good. Now, again, listen, let me go back to the opening balance. By the beginning of this year, you owe your suppliers 10,000. That amount that you owe to them is always a liability. Listen, a liability is always a credit balance. So you bring it down on the credit side. Whatever the amount, whatever you owe them by the beginning, it's a liability. Now, again, it may happen. Here, let me change this. You purchase goods from your creditor called Kamau here down for 5,000. And you debited purchases and you credited Kamau by 5,000. Suppose you wrote to them a check. You, as a business, you wrote to them a check of 6,000. You must have debited Kamau as a creditor. You must have credited bank. Then by the end of the year, you balanced the account and you came and said your balance carried down 1,000. You brought it down by the beginning of the following year, 1,000. So the question is this. do we owe Kamau 1,000 or Kamau owes us 1,000? We purchased goods from them worth 5,000, but we wrote to them a check of 6,000. So it's obvious that now Kamau owes us, not we owing them. Kamau owes us 1,000. So anytime you as a business, you overpay your creditors, though it's rare, but it may happen out of your many creditors, maybe there is one you overpaid. When you overpay your creditors, listen, their account now will be a debit balance, meaning it's an asset from your creditors. You are demanding from them now. Having overpaid them, now you are demanding from them. So if by the beginning, listen, if by the beginning of the year again, you have suppliers who owe you because you overpaid them, who owe you because you overpaid them, that balance will be brought down by the beginning. You come and see your balance brought down, whatever it is. In our scenario, it was 1,000. So what I'm trying to say is this, listen, that just like the debtors ledger had two opening balances, even the creditors could have two opening balances. The most obvious one is the credit one for creditors, because you owe the creditors whatever it is. Good. But we are saying, is it possible that you may have a debit balance? Yes. And this occurs when you overpaid your creditors, meaning now you are demanding from them. They are no longer a liability to you, but an asset to you. It's like a debtor. That's why you bring down. Good. Let's move on. Now, listen. Closing balances. I hope you will listen to it again. Closing balances. Very careful. In most cases, creditors are always a credit balance. We have said that. It's a liability. And a liability is always a credit balance. But you cannot come and bring it down on the credit side again without carrying it down. So by the end of the year, you will now come and say your balance carried down, whatever it is, by the end of the year. So that when you close your account like this, that balance of 10,000 or whatever it will be brought down as a credit balance to represent what the customers or the suppliers you owe, to represent what you owe to your suppliers. Good. Listen. If the question tells you that we have again a debit balance of creditors by the end of the year, a debit balance is to be brought down on the debit side. But again, by the end of the year, you cannot have a brought down without a carry down. So you will come and say here, balance carry down, whatever it is, by the end of the year first. So that when you bring it down by the beginning of the year, it will be shown as an asset, as an amount that you are demanding from your creditors because you overpaid them, so you are demanding from them. It's an asset. An asset is always a debit balance, but you cannot have a brought down on the debit side without a carry down. That's why we are carrying it down first on the credit side. Good. Now, that is it. So that is the format of a creditor's ledger control account. So let's put it down again. So have another paragraph. So say this. The following is the format. Of the creditor's ledger control account. The following is the format of the creditor's ledger control account. The following is the format of the creditor's ledger control account. The following is the format of the creditor's ledger control account. So copy that. Copy that. So the point is, if you know an asset or an item should be debited in the creditors, it should also be debited in the control account. If an item is normally credited in the creditors, it should also be credited in the control account. So ideally, the most important thing here is to know the double entry. If you know an item is normally credited, credit it in the control. If you know an item is always debited, you debit it in the control. Good. To finish, we want to do an example now. Okay. I hope you are through now. To finish, we want to do an example now. So finish. So finish copying. Okay, I hope you are through now with the copying. So finish. I want to project a question. I want to project a question. Okay, so let me hope you are through. Okay, so I hope you are through. You have brought down the balance by the beginning. Both balances brought down. That's what we have said. Then I've told you, when you purchase goods on credit, you owe the creditors. You increase what you owe to them, you credit. If they are charging you for not paying in good time, You increase what you owe to them by crediting. If you pay your creditors, of course, you are reducing what you owe to them, you debit. Whether you are paying by cash or you are paying by check. When you return some of the goods to your suppliers, you reduce what you owe to them by debiting. Those are return outwards. When the customer or the supplier tells you if you pay them within 10 days, you will pay them less, it's a gain to you. You debit with any discount received. Then we have said, that check, if you gave the customer, it became dishonored, remember you debited. Now that it became dishonored, you have not paid them. Increase back what you owe to them. Good. Then we have said, you could also pay them by a bill of exchange. So to you, it became a bill payable, you debit. If that bill became dishonored, obvious, you credit. Then I've said, if one person is both a debtor and a creditor, of course, you do a set-off. A creditor is always a credit balance. To offset that credit balance, you debit. That's why we are saying with a contra, you debit. Then finally, we have said, with any refund from creditors, you had paid the creditor, then he's refunding it to you back. You credit. Good. Then I've talked about the closing balances, very important. If you are told it's a credit balance, you first do what? You first debit. If you are told it's a credit balance. If by the end of the year you are told it's a debit balance, you first do what? Credit as a carry down. Good. So with that idea now, let me project a question. We do it together. That is an old past paper question from your past papers. It's an old past paper question from your past papers. Number A says, explain the purpose for which control accounts are prepared. Of course, we shall explain the reasons. Of course, I've already told you. One of them is you may want to know, could we have committed some errors in the entering of the transactions in the ledger accounts? That's one purpose. It will help you to know. Number two, of course, it will also help you to detect any fraud. Maybe, listen, maybe some of your accounts clerk are committing some fraud. So if this control account is prepared by somebody senior, then the balances will not agree. Don't forget, I told you, listen, I told you the balances of preparing the control accounts are picked from the totals of the ledgers. Therefore, we are saying if the trial balance, we said it's like a trial balance, if they don't agree, then of course you know there will be a fraud, or there could be a fraud somewhere. The other reason why we prepare control account is this, listen, in the balance sheet, we normally take the figure for debtors as a single amount, not the individual debtors, which are 100 debtors. You get the total of them. Creditors, the same. We normally take to the balance sheet the figure for creditors as one amount. So these control accounts will help you to know what is the total value of the creditors by the end of the year to go to the balance sheet. What is the total value of the creditors, debtors, like we did in the control account for debtors here. What is their balances? No. Normally it's the one on the credit side because it's the most time debit balance. What will go to the debtors account as a debtor? Total debtors, this amount. That's what we're saying. So maybe we could even put down the reasons. So have another subheading, a small subheading, purpose of control accounts. Let's answer number A, purpose of control accounts. Number one, to locate errors. That's number one, to locate errors that could have been committed. To locate errors that could have been committed in the entering of transactions. In the accounts. To locate an error that could have been committed when entering the transactions in the accounts. That's number one. To locate errors. Number two, to detect fraud. To detect fraud. Number 2, to detect fraud. Number 3, to determine the amount of debtors and creditors, to determine the amount of debtors and creditors that should appear. To determine the amount of debtors and creditors that should appear in the in the balance sheet. To determine the amount of debtors and creditors that should appear in the balance sheet. Good. So I'm through with part A of that question. Those are some of the reasons why we prepare the control accounts. So let's do part B of the question now. Part B says, XML Limited maintains control accounts in its books or in its records. The balances and transactions relating to the company's control accounts for the month of December 2012 are as follows. So you are given, look at those balances. Balance as at 1st January 2012, 1st December, 2012. Remember, we are preparing the control account by December. That is end of the month. So, by the beginning of the month, it looks like this company has a policy to prepare the control accounts on a monthly basis. No problem. It could be on a yearly basis. It could be on a monthly basis. No problem. Sales ledger. I told you sales ledger is the same as debtors ledger. By the beginning, you can see 6,185,000 debit. At the same time, 52,000 on the sales ledger, 52,500 credit. I've told you, debtors ledger, which is also known as sales ledger, is always a debtor. Debtors are always an asset. Assets are always a debit balance. That's why you can see the bigger amount is the 6.1 million debtors. Then we go to purchases ledger. By beginning of the month, 16,500 credit. That one I told you is when you overpaid them. Now you are demanding from them. Otherwise, the normal creditors is a credit that is 4,285,000. Then you are given transactions for December. Sales on credit, purchases on credit, return outwards. Return outwards. Bill of exchange payable, bill of exchange receivable, checks received from customers, checks paid to credit suppliers, checks paid to suppliers. Let me roll the question. Checks paid to suppliers, then you have cash paid to suppliers, bills payable dishonored, charges on the bills payable dishonored, cash received from credit customers, bad debt written off, cash discount allowed, bills receivable dishonored, balances. By 31st of December, you are given sales ledger. There is a credit balance of 4,000. Then you have purchases ledger. You are given another 23 debit. This time they have given you one balances for each by the end of the year. And it's the odd one, not the normal one. Listen, debtors ledger, the sales ledger is always a debit. Now they have given you the one which is the credit. Listen, meaning now that you will be required to get the other balance on your own. You will be required to get the other balance on your own. Are you there? Good. Then you are given purchases ledger, another one, 23,500. It's a debit. Purchases, I've told you, they are creditors. Creditors are always a credit balance. But here they have given you the debit one. So this examiner wants you to determine the other one on your own as a balancing figure now. Then you are required, post the ledgers, sales ledger, post the sales ledger and the creditors ledger control accounts for the month of December and derive, listen, and derive, in fact they are telling you, derive the respective debit and credit balances of the closing balances. Good. So let's do that now. Let's do that. So we are doing this illustration now. So let's do it very fast. Now you know. So we are doing that handout illustration. Handout illustration. So let's open an account called Debtors Control. Open an account called Debtors. We have said it's called also Sales Ledger or Debtors Ledger. Control account. Then you can open another one. Open another one. Call it Purchases Ledger. Purchases stroke Creditors Ledger. Control account. Good. So we go one item. If it's affecting creditors, you enter in the creditors. If it's affecting debtors, you enter it in the debtors account. Good. So let's go start. Let's go start. By the beginning of the month, we were given the balances. By the beginning of the month, we were given the balances. You are given the sales ledger as a debit of 6,185,000. So let's bring it down now. 6185 as a debit. If it's a balance by the beginning, I told you just debit 6185. Are you there? Good. Then I told you another one. By the beginning, we have a credit of 52,500. 52,500 as a credit. And I told you it's an opening balance, so you bring it down on the credit side. Balance brought down 52,500, I think so. Yes, 52,500. So if it's a debit, you just debit. If it's a credit, you just credit by the beginning. Next, I hope you are through with that. We go to the next one. After that, we go to the next one, purchases ledger. You have a debit of 16,500. Good. Enter it. That's not the common one because it's you must have overpaid them. If it's a debit balance, you just bring it down on the debit side. That is 16,500. Let me confirm. Yes, 16,500. It's a debit. Then purchases ledger has another credit of 42,85 credit balance. I told you if it's a credit balance, you bring it down on the credit side. 42,85. Bring it down. Balance brought down 42,85. Good. So we are through with the opening balances. With the opening balances, I've told you there is no problem. If it's a debit, you just bring down on the debit. If it's a credit, you bring it down on the credit. Okay? Good. Now we can go and record the transactions for the month now. Are you there now? We go and record the transactions for the month. We are given credit sales. Sales on credit for 84.58. When you sell goods on credit, you normally debit debtors and credit sales. So come and debit debtors. How much? 84.52. Come and debit. And you come and see your credit sales. We are given 84.52. Let me confirm. Yes, 84.52. Good. Next one. We are given purchases on credit. Of course, when you buy goods on credit, you normally debit purchases and you credit creditors. So come and credit creditors. It's given as 87. 500. You credit. So come to the creditors and you come and see your credit purchases. We are given an amount of 56.87 what? Let me confirm. 56.87 500. Thank you. Good. After that, we go to the next one. After purchases, we have return inwards. Which account does it affect? Does it affect debtors or creditors? It's obvious. For there to be return inwards, we must have sold goods. So for customers to return goods to us, we must have sold them. That affects the debtors account. We go to the debtors account. When we sold goods to the creditors, here we debited. When we sold goods to debtors, we debited. Now that they are returning, you go and credit. So we are given return inwards of how much? 203,500. Do it. This is return inwards. 203,500. Good. After that, we go to the next one. After return inwards, we have return outwards. Okay. Here is a customer or a supplier we bought goods from. Now we are returning out those goods. When we purchase the goods, we must have credited purchases here. You can see. When we purchase these goods on credit, we credited creditors. For whatever reason we are returning, maybe there were more than we needed or some are damaged, we were forced to return. So we come and debit. And we come and see a return outwards. By how much? 284,000. Good. Put it. 284,000. Good. Next. After that, we go to the next transaction now. We are given, after return outwards, I can see bill of exchange payable. We paid our supplier. Listen, we paid our supplier by signing that bill. So to us as a business, it's a bill payable. It's a bill payable. It's as good as having paid our creditors. How much? 930. When we bought the goods from them on credit, we credited. You can see it here. Now we are paying them using a bill. We accepted that bill. So come and see your bills payable. That is 930. That is 930. Next. After that, what comes next? We now have the next one, they are calling it bills of exchange receivable. You sold goods on credit. you sold you as a business goods on credit. This customer accepted to pay you by the end of the month and he signed that bill. So you received the bill of exchange. It's as good as having been paid. That's what we say. So to you as a business, that's a bill receivable. And it's as good as being paid. How much? $615. So we enter it. You go to the debtor's account and you credit because you have been paid. Come and say your bills receivable. Bills receivable. We have said it's how much? $615. Good. Next. After bills receivable, I can see checks received from customers. That's good. When you sold goods to your customer, you must have debited. Now that you are receiving the checks from him, you debit bank. Obviously, you credit creditors, debtors, sorry. And the amount is given as $79.85. $79.85. We debit bank and we credit creditors. So come and see here, checks received, I think so. Yes, check received. Check received. And the checks that we received amounted to how much? $7,985,000. $7,985,000. Good. We are crediting debtors by $7,985,000. Good. Next one. After we received the checks, what came next? We can see checks paid to suppliers. Checks paid to suppliers. We have just bought goods on credit from our suppliers and we owe them. Now we are paying them. Reduce what you owe to them. So come to your creditors control. Pay them. So we come here and say checks paid. We paid them how much in total for the creditors? $4,773,000. No, $4,732,000. So $4,732,000. Good. That's what we have done. Next one. After paying creditors, what came next? Next one I can see cash paid to suppliers. The same. Cash paid to suppliers is the same as paying them by check. So we still go back here and debit. Cash paid to suppliers, $88,500. Good. You just come here and say cash paid. $88,500. Good. Next. After cash being paid to suppliers, we have bills payable dishonored. Are you seeing it there? Bills payable dishonored. We had paid using a bill. We had paid a supplier using a bill. That bill became dishonored. So we cancel it. So we come to your suppliers here. You can see on the debit, there is that bills payable. It becomes dishonored. So obviously we credit. So come and credit here and say your bills dishonored. How much was the bill dishonored? The amount down there is how much? 400,000. I hope I'm picking the right one. Yes, 400,000. Good. Next one. After bills dishonored, we have the next one. Charges. Charges. on the bill, charges on the bill payable dishonored. Listen, we paid the supplier by check, by a bill on the debit here. That bill has become dishonored. We have credited. Now the supplier is even charging us more interest or whatever charges they are saying. Charges on the bill payable dishonored. So we incur more losses. We owe them more. They are charging us interest or whatever charges it is. So come and see here, charges. Charges on bills payable. Charges on bills dishonored. Charges on bills dishonored. Charges on bills dishonored. Dishonored. I think it was 10,000. I'll confirm. Let me confirm. Yes. Good. Next one. Let me roll the question. Next one. After that, charges on the bills dishonored. We have cash received from credit customer. That's okay. We are just sold goods to your customers. Now they are paying us. So we reduce what they owe us. Cash received. So go to the customer's account. How much? 153,000. Come and see your cash received. You go to your debtors account. You come and see your cash received. We just sold goods. Now they are paying us by cash. 153,000. Good. That is it for that one. Next. After cash received from customers, I can see the next one is bad debts written off. That's good. We are just sold goods to a customer. He can't pay us now. Write him off. How much? 64,500. I hope I'm picking the right one. Yes. Bad debts. We sold goods to a customer. We debited. Now that he can't pay us, we credit. And we come and see your bad debts. 64,500. Let me confirm the amount. Yes, 64,500. Next. After after bad debts written off, we have discount allowed. Obvious, you normally allow your debtors. You normally don't allow your creditors. Creditors are the ones that give you a discount. So if it was discount received, it will go to the creditors. This one is discount allowed. And it is you, the business, who allows your customers a discount. So this is discount to customers, not from suppliers. No. And the discount allowed is 302,000. Good. Come and put it on the credit of the debtors. So come and say a discount allowed. 302,000. Good. Next one. After discount allowed, we have bills receivable dishonored. We received a bill from our supplier. No, our customer. We sold goods to your customer on credit. That customer promised that he will pay you in good time. But he accepted a bill. So when he accepted, you received the bill. So it became a bill receivable to you as a business. Now it has become dishonored. So we go and cancel it. Where did you record it? On the credit. You can see it here, 615. Part of it has become dishonored. You debit. You come and see your bills. receivable or bills received dishonored. How much? 88,500. 88,500. Good. That's all. We go to the next one. After that, what comes next? Good. Now we go to the closing balances. We are given the balance at the end of the year or at the end of the month. On the sales ledger, listen, on the sales ledger, I can see it's a credit balance of 44. A trick there I've told you, it's a sales ledger, a credit balance. Here, this is our sales ledger, a credit balance, a credit balance. I have told you a credit balance by the end of the year should be appearing on the credit side as a brought down. But I told you cannot have a brought down without a carry down. So you come and see your first balance carried down. How much? It is 44,000. Is it 44? Let's confirm. Yes, 44,000. Then what about the next one? Purchases ledger. It also has a debit of 23,500. Debit. A debit by the end of the year should first be carried down on the opposite side. You come and see your balance, carry down. I hope you are following. That is 23,500. So that I told you when this account is closed, that will now be a balance debit here of 23,500. Then when you close this other one, it will be a credit like we have been told. It will be a credit balance on the credit side, balance brought down of 44,000. So what this question was not able to give us was the other closing balance, which means you must determine it on your own. You must determine it on your own. So finish. I want to get the balances by the end of the year. We want to get the balances by the end of the year of those two accounts. What is the normal debtors by the end of the year? What's our normal creditors by the end of the year now? So let me be adding now. I get the totals on the debit. On the debit of the debtors ledger, I take that 61.85 plus 84.52 plus 88,500 plus 44. So on the debit of the debtors, I am getting a total, you confirm my figures, I am getting a total of 14,769.5. Good. What about on the credit? 52,500 plus 203,500 plus 615 plus 79.85 plus 153 plus 64.5 plus 302. On the debit side, the credit side, sorry, I'm getting a total of 9,375.5. Now I get the difference. So I subtract 14,769.5. I'm getting a carry down balance. Come and see your balance carry down. We are getting 5,394,000. Good. To get that total of 14,769,000, 500, 14,769,500. Then you bring down the balance now. So come and see your balance brought down. We have carried it down. Now we bring it down. Looks like 5,394,000. Good. So we are through with the debtors ledger. We are through with the debtors ledger. Now finished, we want to go to the purchases ledger. We were given one balance by the end of the year. We had to determine the other balance just by balancing the account as normal. We just balanced the account as normal, so finish copying. So we have got the balance of the debtors, 5,394,000. We have got the totals. Then you bring down the balance. That's all. So I want to do the last one, that is the purchases ledger or the creditors ledger. So finish copying if you are still copying. Good. Let me hope you are through now. We now go to the creditors ledger. Let me start by adding the debit side. Let me start by adding the debit side. 16,500 plus 284 plus 930 plus 4,732,000 plus 88,500. On the debit, I'm getting, let me note it somewhere, I'm getting 6051. 6051. What about on the credit? 4285 plus 5687.5 plus 400 plus 10,000 plus 23,500. I'm getting a total of 10,406 on the debit. 10,406. I minus 6051. I'm getting a balance on the debit. Balance carried down. I'm getting 4,355,000. This gives me a total of 10,406,000. 10,406,000. Then I bring it down. I bring down the balance, which is balance brought down. That is 4,355,000. Good. That brings me to the end of that question and also to the end of that topic of control account. So I want to believe that you have managed now to understand the concept of control account. The point is, if something is normally debited in the debtors, it should be debited in the control account. If something is normally credited in the creditors, it should be credited in the control account. Good. That's the concept. So ideally, you should know the double entry. Okay. So that brings me to the end of that question. Maybe we can stop there. We pick it up from there next time. We now pick it up from there next time, when we shall now start a different topic now, where we shall now do a different topic. See you next time. Bye. Okay. So we are saying see you next time, when we shall now start a different topic. Now you can practice some questions.